So in traditional markets, we've long recognized that passive vehicles like index funds and ETFs distort price discovery. And in crypto, that concept now is looming large. Spot ETFs, DATs, balance sheet holdings are all channeling unprecedented institutional capital into digital assets. The question is, do these passive flows enhance efficiency, or do they really reshape the markets beneath the surface? And we have a great panel to help us answer this. We'll go down and introduce ourselves, please.
So my name is Shiliang. I'm the managing partner of Monarq Asset Management, multi-strategy hedge fund in crypto, do a variety of quantitative directional strategies, have invested in several DATs, as well as working with a handful of DATs on treasury management as well.
Hey everyone, I'm Maxime, Seiler, co-founder of STS Digital. We're a principal dealer in options, serving institutions from foundations, venture funds, hedge funds, to traditional investors in accessing and trading options on crypto.
Hey guys, Matt Zhang. I'm the founder and managing partner of Hivemind Capital. Hivemind is a global investment firm focused on crypto, blockchain, and with office in New York City, London, Hong Kong, and yeah, glad to be here today.
Hey everybody, Eric Rose, head of digital asset execution at StoneX Digital. StoneX Digital is the digital asset arm of StoneX Financial, which is a global financial services firm that trades pretty much every asset on the planet. The digital business trades both spot, custodial, non-custodial, as well as collateralized lending and soon derivatives.
So let's start off where all of this begins, the inflows. So Matt, how have ETF inflows and balance sheet allocations changed how capital enters crypto markets? Are these flows stabilizing or distorting liquidity?
I think if you look at where our industry is at today, and if you draw analogies like the ETF as a wrapper, really, and when they wrapped gold and wrapped other asset classes in the past, I actually definitely don't think we're stabilizing here. I think that early last year when you actually have BTC ETF got approved, this is the beginning to open up a floodgate for investors be able to access crypto, but in a traditional financial instrument. I can't tell you how many times when we're talking to potential LPs, they're trying to find a way to get crypto exposure, but trying to stay within their existing lane of the strategy. So be able to put BTC, ETH, and many other cryptocurrencies in the ETF, give the large asset locators, institutional investors, the easiest way to be onboarded to this. Obviously in the last 18 months, many people who invest in the ETF now sitting on the profit and thinking about what they're going to do with that. I think that and many other financial engineering instruments that we're seeing, will continue to sort of prosper from there. But I think that, number one, we're at the beginning of seeing a massive inflow, and there's going to be even more via ETF, DAT, and many other ways to come into this. And number two, I think they're going to actually increase the liquidity of the market. I think the price distortion may happen at some stage of the industry, but I don't think it's anytime soon. Like, give you an example, right? I think in crypto market, I think the derivative side is extremely underdeveloped. You can't even get a 5-year ETH call. Nobody will short you that option today, that gamma today. But when you're wrapping BTC, ETH, and so many other cryptocurrencies in traditional market, whether it's an ETF, index, or that, all of a sudden, because you have the option market, derivative market on those public equities, you will be able to unlocking a lot of ways for liquidity on the derivative side. So I think, liquidity gets you more liquidities. From that perspective, I think this is actually hugely unlocking the liquidities and adoption, and that's the phase we're in today.
Eric, give us a perspective of what actually happens when these ETF and DAT flows arrive. Do we see measurable impact on spreads, on depth, on venue fragmentation?
Great question. And I would actually separate the two because obviously ETFs are priced during specific windows, usually between 3 and 4 p.m. So that's both, you would think if everybody knows that, there are large creates today, that would create, upward price movement. But the reality is a lot of market players are aware that liquidity increases during that pricing window. So if I'm a seller, I know that there's much higher liquidity between 3 and 4 p.m. So you do end up getting that balance between the two. And because the timing is so specific, it's easy to see and track. On the DAT side, that's an actively managed purchase, right? And we don't know when that comes. So that could be 3 in the morning, could be whenever somebody wakes up and decides that they want to add to their treasury. Obviously, when you see like a MicroStrategy going to market with an ATM or some other preferred product, you know that they're going to be in the market at some point. We just don't know when.
Let's take that one step further into some more of the market mechanics and into the alpha. Shiliang, when ETF or DAT flows surge, how do they ripple through perps and futures markets? Do we see feedback loops or new inefficiencies there to take advantage of?
Yeah, and before I answer that, I just actually want to touch on one point that, like Matt mentioned, that I completely agree with. I think if you look at like this cycle, people kind of look at top line numbers and they see just a massive amount of capital that have in theory come into the market. But I think like if you peel like one layer down, a lot of it has been kind of in-kind contributions from holders of, let's say, Bitcoin, 5, 10 plus years, right? There's been an astronomical amount of, call it long-dated Bitcoin holders that have moved their, holdings. And a lot of them actually have moved it to ETFs or DATs, right? And it kind of subscribes to the reason for that is, one, and it's kind of counterintuitive in the sense that you would think that they subscribe to the old idiom of not your keys, not your coins. But in some ways, by actually subscribing and contributing their kind of tokens to a ETF or a DAT, they've unleashed and unlocked way more financial opportunities. And in some ways, they make it anonymous in the sense that a lot of these old wallets are tracked and monitored all the time on the blockchain. But once you actually subscribe to a DAT or an ETF, in some ways you are now part of the global financial system, and in many ways you are anonymous from that perspective. So there's been a huge appeal, and that actually does affect flows in the sense that not every dollar that has flowed into DATs or ETFs is actually a dollar of demand or a dollar of buying. I would say a vast majority of that actually has just been in-kind contributions, right? And kind of explains why prices haven't necessarily just gone parabolic across Bitcoin, but also all the other altcoin DATs as well, right? Because a lot of it has just been in-kind contributions. And then pertaining to flows, absolutely, right? I think some digital asset treasuries, the size when they launch is something like 5 to 10% of outstanding floats. Not talking about Bitcoin, Ethereum, but certain other tokens. So actually that obviously distorts markets in some regard. A lot of these fundraisers are public in the sense that there's a roadshow. You kind of know when they're going to close, when they're going to launch, when the funds are going to be deployed, when they're going to start actually buying the tokens. So market participants are smart, right? And they would obviously try to front run that flow. Part of it is obviously rippling through perp markets and spot markets, even options markets to a certain degree. So it's a huge amount of capital, and crypto in itself is still pretty illiquid, right?
So Maxime, you and I had a good conversation around this, some of the structural comparison of the pieces there. How are DATs different from ETFs in terms of market footprint and investor intent? Are DATs stabilizing long-term holders or new volatility amplifiers?
Yeah, it's a good question, and I think it's important to break it down. One, in terms of the product itself as a DAT or as an ETF, and then again within those two product or investment product classes into what the strategy actually is. And I think it comes down into what the strategy is and how it gets implemented which matters a lot in the long term in terms of like how the dynamics will be on the returns for investors. So if you just look at an ETF as an example and you want to have levered exposure, in theory, you could implement that very easily by just buying BTC and then buying an overlay, a call option, or you could be using derivatives in different ways and form to either increase the exposure on your upside or to earn yield on top in BTC. As example, by selling put options, put spreads, or implementing more complex type of strategies. Now, if you do that, the P&L will come back into the NAV, and through that directly be reflected to the ETF holders. If you go into a DAT and you try and just get a basic levered exposure to BTC and accumulate more BTC, essentially what happens is that a lot of these financing mechanisms, they are not going to be explicitly on the price in terms of mark-to-market impact, but much more about in the long-term potential additional dilution on the equity. So it's less visible, it's a little bit more opaque in terms of like what and how that sort of additional BTC yield might reflect for the owners of DATs in the long term. And so it really comes down into like what the implementation is of the strategy. I think in some cases, you could just implement it very easily by taking an ETF and implementing a levered strategy in there, especially if it's looking at BTC or ETH. But then on the other hand, if you look at altcoins, I think there is a lot of value that can be unlocked by structuring deals and putting them into DATs that are more complex to structure and can only be done through a actual operating company. One example I think that is actually really interesting is that in the past, a lot of the locked tokens would trade at significant discounts, and there was not that much liquidity and demand in the market to absorb those locked tokens. And as a consequence, they would trade at significant discount, up to like 40-50% below the spot market. And I think for DATs, that's a perfect use case to just use those assets, given that they're long-term and they're not going to get redeemed anytime soon, and then buy up those locked tokens and then hold them and then realize that gap over time. So I think it all comes down into like what's the implementation, who's managing it, and in the long term, there's going to be a lot of segregation and differentiation in terms of like companies that will create real value, and then a lot of companies that will just end up running high operating costs and not creating tangible value for the investors.
Adding on to that, Eric, do DAT-driven trades look different from ETF flows?
They certainly should. It's obviously, as I mentioned before, it's an active strategy. But as Shiliang mentioned earlier, you are taking a lot of in-kind creations, or as Maxime mentioned, buying from foundations at discount prices. So, the mechanics are certainly different from that perspective. And how do they distort? I think something that we don't really want to talk about too much because everybody here is invested in DATs is like what happens when MNAVs go below 1 and your optimal capital structure trade is now to buy back stock and sell tokens, right? So I think that the DATs have an impact on markets, especially as you move down the market cap curve from Bitcoin and ETH down to some of the more alt tokens where that potential impact is something to keep an eye on. Not saying that that's going to be what happens, and certainly there are other capital structure trades that can occur when DATs trade below 1 MNAV, but it is something to keep an eye on in terms of negative feedback loops.
So what if there were problems, like Shiliang, if we faced sudden redemption or macro shock, how would these passive structures behave?
Yeah, I think it's, so historically in crypto, there's been more volatility on the upside than the downside, right? It's kind of like why when you look at like vol surfaces, vols are, that vol surface is more bid on the upside versus downside versus, let's say, traditional equities. I think it'll be interesting this cycle in the future to see whether that perhaps shifts as more traditional capital has now entered crypto markets, right? Whether perhaps now on the downside, you will actually see a lot more volatility and unwinding than historically, right? Yeah, especially with just looking at this year, right? Bitcoin until let's say the last month has kind of grinded higher throughout the year, but implied vols and realized vols have just been rock bottom, right? It's been the lowest it's ever been historically ever for Bitcoin, and part of that might be explained by it's just more. It's a much larger asset, but also it's more traditional capital, right? I think it'll be interesting to see in the next, let's say, bear market or leverage unwind or whatever, whether, we already got one in October 10th with the crypto markets, in call it the next macro shock that will affect, call it traditional instruments like ETFs and DATs, whether you'll see actually a lot more volatility on the downside as a result of that.
Matt, are there any transparency or guardrails that you think could ensure that this passive adoption doesn't compromise markets or price discovery?
I think before addressing the price discovery, I think that it's a good question to even talk about like what that 1.0 as we know it has come to what it looks like today. And I think there's a big elephant in the room to address is because a lot of the DAT today existed was people trying to find different type of loopholes of NASDAQ rulings to bypassing shareholder votes to get to the stage as fast as possible. And a lot of them probably shouldn't be here in the first place, right? So I want to take a step back and say that is a terrible passive structure to access crypto. If you just want to access crypto, you just buy the tokens, put in your ledger, or you buy the ETF and pay the 35 basis points. That's it. If you're going to buy a DAT, not only is it an active strategy, it actually needs to be active beyond just simply timing the buy and the sell and trying to timing the share buybacks or issue more pipe and converts. I think that will be only meaningful if there is actually an operating business attached to it, and that operating business actually is meaningful for the underlying token as well. I think, unfortunately, we haven't got there because how that all happened early this year is because people find two routes, either go to the de-SPAC route or go through a pipe, RTO without the approval route, and both of which, come back to your question, is there was not a lot of the guardrails, and then, we actually led that and invested in a bunch ourselves, and then we're talking to NASDAQ, we're talking to many of these people, right? Like regulators actually want to making a lot of this happen, but they also have a knowledge gap. They're actually taking time to understand exactly what's going on. And when you're having all of this coming out, mushrooming left, right, center, every single token on the league table want to launch their own DAT, and you have the foundation buys from the discount, it's actually very, very confusing. So I think I would say today's the DAT market will completely get washed. There are going to be winners, but there's a lot of things just not going to work because they probably didn't have the right asset management team. They didn't have the right management team. They didn't went through the proper shareholder vote. They probably never thought about, apart from buying the tokens, what else they're going to do. So, however, I think history is past dependent. Because now we have this concept called DAT, I think there's going to be very, very thoughtful people, smart people thinking about, okay, the market's going to come back. Just like 6 months ago, everything trading above 2x NAV, and now a lot of people are trading below 1x NAV. The market going to come back. So, and one time it's come back, you're going to have more thoughtful people to say, if we're going to launch a DAT, they need to have a soul around the DAT, not SOL, but SOUL, right? You have to actually understand what you're trying to do. So I think that is the moment to say, like, the DAT would actually have a lot of meanings. There needs to be guardrail, there need to be rules to making sure this is not just a passive investment vehicle. I mean, take a step back. I personally believe in 5 years' time, every single Fortune 500 company is a DAT company. If you think about it, there is already exist. The block, which used to be called Square, they actually hold a lot of Bitcoins. But you never actually put them to that in the first place. Why? Because they have an operating business, which is a payment company that produces real cash flow, real revenue, real EBITDA, and you price it on a multiple basis. I think going forward, just like today, a lot of the Fortune 500 companies hold dollar, euro, yen, and pound, they will absolutely hold BTC as well, which is going to become the world reserve currency. If that's the case, you could argue at some level, every single company there is a DAT company. It doesn't stopping them having a relevant operating business on top that actually producing enterprise value beyond simply book value. I think that DAT 2.0, 3.0, only when if we get there, then you'd argue that's actually a real active strategy, that your operating business have a flywheel with your treasury business, with your treasury strategy, and not just trying to hoping you're going to trade above sort of your book and be able to issue more stocks. So,
If I may, I would actually, not only do I support that, but it actually becomes to the point where you can't really measure MNAV anymore because you have all these other things that are going on behind the scenes. Like how many OTC derivatives do you have that are protecting your DAT? So as Bitcoin goes down, you should be price protected, right? And so, and as whether you're a proof of stake company that is validating or generating yield, like the markers that we use to calculate MNAV, which is just the token value divided by your market cap, no longer really actually reflects the value of the company. And I think that will probably change as we go to DAT 2, 3, and 4.0.
Yeah, I would just, I completely agree. I would push back in the sense that it's a lot harder to run a profitable, real value-generating business than a digital asset treasury, right? And so then the optimal path probably shouldn't be, let's raise a bunch of crypto first and then find a product market fit in a company versus actually doing like a real company first and then backing into crypto.
Maxime, are you of the same mind that crypto or that corporate treasuries will start accumulating more digital assets?
I think to Matt's point about the currency diversification, I think that's a growing topic, especially for foreign companies that have dollar revenues, and where it is a real question that you have to sort of ask yourself is like, in what currency do you want to hold your balance sheet? How do you want to use your excess capital? And also just in general, currency diversification is becoming, again, a bigger and bigger topic. So I think from that perspective, there's definitely a point to be made that holding real assets, it could be gold, it could be BTC, it could be other crypto, that it can be done in some weight on a balance sheet. I think the differentiation of a DAT and a business that holds crypto is also an important differentiation that needs to be made. And it's I think fairly likely that very viable businesses in the long term are going to start holding some BTC or some other assets, but just in small portion. And that might gradually increase over time. But I think the businesses that are today not very viable, that have shrinking margins, that have a business case that is not really viable over the next 3 to 5 years, transforming them into DATs is a good short-term distraction. But in the long term, I think the market will look through it and realize, okay, the underlying business is just flawed, and those margins are going to shrink, and therefore that's just going to add more pressure on the MNAV.
So to start wrapping up, we'll do just a quick lightning round of expectations for 1 year from now. So by the end of 2026, do each of you think that passive flows will be stabilizing, distorting, or transforming crypto markets, or none of the above? Shiliang?
Yeah, I mean, I think passive flows will continue to grow, right? The whole space is getting more institutional. Every other asset class has followed similar paths, and I think crypto will follow a very similar path as well. So yeah, absolutely, it will be transformative, and we'll see more and more passive ETFs and other products.
Maxime?
I think that the general exposure towards the asset class is just going to go up, be it through DATs, be it through ETFs, be it through other managed strategies. And I think, if anything, the demand for risk-adjusted upside exposure is going to be one of the biggest inflow in terms of strategies. Be it done through options, be it done through DATs or other ETFs. I think the demand to get exposure through options is the one big growing product class in the fastest growing asset class.
I think 12 months from today, we're going to still fight for global inflation, but we're probably going to get 3 or 4 more cuts. the IPO window opens up, and you're going to have a lot of crypto company go public. I think some of the DATs are going to die, but you're going to have this DAT 2.0 coming up and trying to find a different way to actually run a different type of strategies than the passive vehicle like ETF. I think that more tokens are going to launch their own ETF. I think there's a lot of TradFi people who have capital net inflow into both ETF and DAT and single name crypto companies on the public market, which make public equity market in crypto one of the most interesting playground for the entire space. I think you have arbitrage guys trying to buy the MNAV below 1 DAT and short the ETF to trying to close the gap, which bring even more volume and liquidities and price discovery to the space.
And Eric?
Tough act to follow there. I certainly think that we'll see more, obviously, single token ETFs approved, and we'll see more liquidity from that. You know, if you think conceptually about in-kind creations, you do kind of create exit liquidity for original token holders into new public equity buyers. So you have new investors coming to the space, providing liquidity for old investors. So I do think you'll see an increase in liquidity for sure. I think, again, you'll see some more DATs. I think you'll see M&A in the DAT space because I think you're going to see, you know, some of these companies don't really have a viable business. They don't have a lot of market cap, and they're trading 0.5, 0.6, 0.7 MNAV. And you're going to see some of the larger ones come in and try and do something there. Some will be effective at doing it. Some will not. But that would certainly be something to look for.
So ETFs and DApps and use of corporate treasury may define the next phase of the market structure, and how we manage that evolution will really shape crypto's maturity. Thanks to our panel, and thanks for joining us today.